Selling options is the closest thing to printing money. It's like a dividend on steroids. And I've personally made over $1 million in premiums, cash secured puts, and covered calls. Pure income. But here's the kicker. There's one piece of information I wish I'd known when I started. It would have stacked even more cash, even more papers, and even more income through premiums. Don't bounce, because today I'm spilling that secret to you. This is the kind of knowledge that turns options into a money printer. So stick around. You definitely won't regret it, specifically in today's market and in today's red market crash. Now you're probably thinking, who's this guy and why should I trust him? And in reality, that's very fair, and you shouldn't trust me because this is not financial advice. I'm just showing you my own personal plays, talking about what I personally do. I'm literally a nobody to you. I won't bore you and won't waste your time with the full $1 million saga. But let's zoom in on the last month alone, where I pulled in nearly $50,000 in premiums. That's real money hitting my account, and it's not a long shot. It's not a one and done. I do this monthly, bringing in tens of thousands of dollars. So don't just take my word on it. Watch the screen, because I'm going to show you the receipts. If you're only listening, now is a good time to peek up. This is where I prove to you that I know my stuff before dropping this game-changing secret. I want to make sure that you don't think that I'm showing off or boasting. I'm just establishing authority in the subject matter spoken. Here we go. First, let's start with ticker symbol MSTU. This is a leverage crypto play on MicroStrategy. On March 28th, I sold 200 cash secured puts at a 350 strike. That's $3,000 in my pocket. That same day, I sold 200 more at a $2.50 strike. That's another G-bone in my pocket. March 19th, I rolled 199 contracts at a $7 strike, banking in another $10,079. Back on March 10th, 33 contracts at $7, banking in another $10,890. That's crypto cash flowing. Let's move on to SoFi, which is a fintech banking beast. On March 19th, I rolled 267 cash secured puts at a $14 strike for $11,675 collected. Then I wheeled it, sold 13 covered calls at $14, snagging in another $390. That's income on top of my income. Let's go to Robinhood, which is a trading app king. Absolutely love this company. Made nearly $1 million on it last year alone. March 27th, 26 cash secured puts at a $38.50 strike, bringing in $2,262. March 3rd, 9 contracts at $44, bringing in another $1,035. And I rolled those 9 contracts on March 19th for another $1,750. Now, I'm not sure if this adds up to $50,000 or not, but I got so many more receipts. The list keeps going, but your time is very valuable. I'll stop here. The point is, I've got skin in the game, and last month's 50K haul, that's me walking the walk, not just talking that bullshit. And I'm not some armchair guru. I live this, and it's made me a millionaire in premiums alone. If you're new here, my name is Adam, and I retired in 2024 at the age of 41 years old. My retirement is built on a unique 3-part approach: the multi-bagger for asset accumulation and appreciation, the dividend machine for high-yield, consistent distributions to cover your bills, and the options income strategy to accelerate passive income with covered calls and cash-secured puts to fund your retirement in style. If you want to learn how I did it, stick around and you'll see exactly how to retire early. So now that I've shown you the money, let's get into the good stuff. There's one secret that nobody told me when I started selling options. One trick that could have juiced my profits even higher. It's a simple and powerful tool, and it's about to change the way you see this game. You ready? Here's the $1 million nugget I wish I knew from day one. On red days, do not be scared. Take advantage of red days when you sell cash secured puts. On the vice versa, on green days, take advantage of selling covered calls. A cash secured put on red days increases the implied volatility, which increases the amount of premium that you make for selling contracts. However, on green days, if you own shares and you sell covered calls on those shares, that increases the implied volatility, and this brings in a better premium when you are selling covered calls. A covered call, you own 100 shares, you sell a contract against that. A cash secured put, you don't own the shares, you are securing selling that put with cash as collateral. At the end of the day, nobody ever told me this, and I had to learn it the hard way. It might sound simple, especially let's concentrate on the red days like today. As a matter of fact, not only do we have a red day, we have a red week, we have a red month, we actually have a red quarter. But you need to lean into the red, and that's some of the best possible days to sell cash secured puts. On Friday alone, where the market was super, super red, I ended up collecting $4,000 from selling those cash secured puts on MSTU. So you might say, Adam, well, thank you for the lesson, but why? What does this exactly mean? And why is it good to sell on red days? Because we might get assigned. Well, getting assigned is when the contract actually finishes in the money and you have to buy the shares in terms of cash secured puts, or selling the shares in terms of a covered call. As a beginner, and this video is specifically for you as a beginner getting started in selling options. Now, a beginner can be 1 day, a beginner can be 1 week, a beginner can be a month, even a year or so until you have some knowledge and experience in selling options. As a beginner, you should focus on certain things and understand certain things, and then later you'll be able to cater specifically for your game. You'll be able to get your game plan going. So whatever I'm talking about today is specifically for a beginner. If I was starting again as a beginner, and this might not necessarily be what I do personally in my options. As a beginner, you should know that it might take a day, it might take a week, it might take a month, it might take a year, it might take several years. But in general, the United States stock market goes up and to the right. And up and to the right means that it's bullish over the long term. If you know that and you're selling cash secured puts, and even if you get assigned and you buy shares over the long term, those shares are going to go up and you're going to end up making money. You're going to be able to sell those shares for more money, or at least as much as you ended up buying those shares. The whole time you're going to be collecting premiums to offset your cost basis. And if you know that the stock market goes up and to the right, it's bullish over a long period of time, I'm talking about decades, and you're picking the right companies, well, then you have a winning formula. At the end of the day, time in the market is better than timing the market. And if you stick to a couple of basics, which I'm going to go over in just a moment, well, this drastically increases your chances of making more money while selling options and playing it smart. Greed is the killer when it comes to options, specifically selling options in today's video. If you are picking the right companies, and what's a right company? A company that you know inside and out, a company that you know that if you were to buy the shares, you will have no regrets. Think about companies like a Google, like a Meta, like an Nvidia, like a Tesla, all the Mag 7s, strong companies, right? You know that over time, those companies are going to go up because these are literally the companies that's the backbone of America. And you could input any company that you'd like that makes sense to you. I'm just giving you some examples. So you know that if you sell a cash secured put on Google or Amazon or Meta, whatever, any of these companies and Tesla and things like that, in the future, as America goes up, these companies will go up. So if you get assigned, it's okay. You end up buying the shares at a discount because you bought the shares at the strike price minus the premium that you collected. It's like somebody saying, hey, come to the Mercedes dealership. We're going to give you a 5% discount on your car, but you have to wait a month. And if we don't give you that car in a month, it's okay. You can still keep your 5% discount, right? That's kind of how this works. So if you understand how the market works and you're getting the right companies, then you shouldn't be worried about leaning into red days, because the red days is what's going to give you the most premiums when selling those options. You get what I'm trying to say? When you are selling those options, there's a couple of things that you need to stick to. We spoke about how to pick a company that you want to start with, and then you cater the plan based on the company that you picked, and you could pick another company, or you can add to this, or pick a few different companies. You're going to start getting a feel for it. But at the end of the day, you pick your company, and then you sell an option that's 20 delta or less. 20 delta selling an option means that it's 80% in your favor, that it will not expire in the money. I'm going to assume that you know what I'm talking about. If not, click on the link up above. It's a video that I go into detail a little bit more about all of these things, about how to find the right stock to pick and the right strike prices. So now you know what stock you're going to pick. You know what delta to pick. The expiration date is going to be 4 to 6 weeks. I personally enjoy 4-week contracts, but 4 to 6 weeks at a 20 delta is the golden rule when it comes to selling options. And once you find around 20 delta, and around 20 delta can mean 22 delta, 18 delta, so on and so forth, you find the right stock. And 4 to 6 weeks, you want to collect 2% premium on your money on your collateral. So if you're putting up 100K and you're doing it for 1 month and the 20 delta, you want to get at least $2,000 in premium. If you're doing for 6 weeks with a 20 delta on the stock, you want to be able to make at least 3% of your money, right? 2% per month. So if it's 1.5 months or 6 weeks, you want 3% on your money. If you can pick 20 delta, a company that you know, love, know inside and out better than you know yourself and wouldn't mind to hold, you do it 4 to 6 weeks out and you're able to collect that 2% a month, then you Gucci. You did your job. You picked the right company at the right strike, at the right delta, at the right expiration date. And if you can do this and not get greedy, well, congratulations. This is literally the stepping stone of a beginner. Now, if you're doing this and you're doing this on red days, you can increase that 2% to probably 2.5 or 3%. You're not going to get rich off of this, but you are definitely going to increase the income that you make off of selling options. Now, this income that you're collecting can be 50K like I made last month. It could be $100,000, $1 million a month. Some people are absolutely crazy. Or it could literally be $1,000 a month or $500 a month. Whether you are retired like myself, aspiring to be retired, or you work 9 to 5 and you want to supplement your income, or you're saving up for a wedding or a house or a vacation, or your kids are coming and you want to buy them something. Well, this is a strategy that works for you. In the future, when there's going to be green days, I'm going to be talking a lot more about covered calls, but over the last quarter, we're getting absolutely annihilated. And if you are underwater on your options, if you are in trouble on your options, don't worry about it. Click on the video up above right now. And I talk about the strategy called wheeling, and I talk about a strategy called rolling. Real quick, rolling is when the contract is coming towards the end, you are underwater. So let's say you have a $14 strike, the shares are $13, and you don't want to buy the shares. Well, that's fine. You roll it. And rolling just means that you take your existing contract with existing premium, you close this out, and you sell a new one with a new strike price or the same strike price and a new expiration date. The contract that you open has a premium, and the premium on the contract that you open most likely will be enough to cover the premiums that you owe on the contract that you are closing. As long as the price is within 20% of your strike price, the roll is going to be good. If you're within 10% of the strike price, you're probably going to be collecting around 50 or 60% of your original premium that you collected, even after you cover the initial premium. And if you're within 2, 3, 4% of the strike price, you're probably going to make more money on the roll than you initially did opening up the contract. And if the roll doesn't work and you get assigned the shares and you don't want to keep the shares, you can do something called wheeling. So if you have a cash secured put where you get assigned and you have to buy the shares, don't worry, just sell a covered call on the shares that you bought. And if you have a covered call where you have to sell your shares, don't worry, that following Monday or whenever your contract expires, just do a cash secured put to rebuy the shares that you sold. Now, in the future, we're going to be going over share prices and strikes and more techniques, but don't be scared of red days. Follow the rules of 20 delta, 4 to 6 weeks out, 2% a month on your money. Stocks that you know, stocks that you wouldn't mind to keep. If you get underwater and you get in trouble, roll. Worst case scenario, you don't roll, you can't roll, you get assigned, wheel the shares, keep collecting your premium, and reduce your cost basis on top, above, and beyond the strike price. Because the cost of the shares is not how much you paid for it, it's the cost of how much you paid for it minus the premiums collected, both in the initial option that you sold, as well as the roll, as well as the wheel strategy. And if all else fails and you don't want to wheel and you don't want to roll, well, if you pick the right company at the right strike, at the right deltas, so on and so forth, you wouldn't mind to own the shares because you ended up paying for the shares cheaper than you would on the open market because you got that premium discount to own those shares. At the end of the day, don't get greedy. Start small. Try to open up one contract on a stock that you know very well, whether you own 100 shares or whether you want to buy 100 shares of those contracts. I don't suggest being too excited to sell covered calls on red days, although I do it. But as a beginner, if you want to get into selling options, on red days, sell cash secured puts. On green days, sell covered calls. If you are not excited whatsoever to make millions of dollars, tens of thousands of dollars, and supplement your income selling options, that's okay. You don't have to because I got you. I also have a lot of dividend high income ETF that do selling option strategy for you and give you a fat ass dividend. And if you want a company like that, click on the link up above. This is QQQI paying a 14% dividend. The underlining that they sell covered calls is actually the NASDAQ 100. So you get access to all of the best companies that we spoke about earlier. In the comments, let me know down below. I'm out. Peace.